mean low. Business exclusive from Charlotte, North Carolina. It's Cameron Hight, risk manager with Alpha Theory. You don't like dividends. You don't recommend them. Why?
Well, I don't hate dividends. I just think they're a bad use of excess cash for a cash flow generating company. A cash flow generating company has multiple options. You know, they take that excess cash and they can employ it back into R&D or sales and marketing or make acquisitions. But if they can't find positive expected return investments that are in excess of their return on equity, then they have to take that excess cash and give it back to shareholders. And they have really two options, either buybacks or dividends. And I think it's important for investors to understand that buybacks and dividends by themselves really don't create value. So, you know, in understanding that, you could say the Apple dividend. The Apple dividend is roughly $10 billion. $10 billion comes off of Apple's balance sheet, so the Apple itself is worth $10 billion less. But investors get $10 billion in their bank accounts, so the net difference is zero. In a buyback, it's sort of the exact same thing. $10 billion comes off of Apple's balance sheet, but every equity holder gets a little bit more of the company, so it's net neutral as well.
So it's a taxable event. I mean, what you're describing is this taxable event that becomes a tax negative. In particular, if the Bush tax cuts expire, tax laws change, it's going to be a massive change for 2013.
That's exactly right. I mean, the difference is that buybacks and dividends are both net neutral when it comes to a value standpoint, but which one's more efficient, a buyback or a dividend? Buyback, you keep your whole dollar. A dividend, you get paid $1, but you end up with 85 cents today. And January 1st of 2013, you end up with 65 cents if you're a 35% tax bracket.
You know, when you look at somebody like Apple, I think that's the best and most recent story of a major dividend story. What do you think they should have done with that cash? I mean, if it wasn't to do a dividend, stock buyback, fine, that's fair enough, that's one option. But when you're sitting on more than $97 billion in cash like Apple was, and you're under a lot of pressure by your shareholders, which are mostly institutional, we should point out here, then what do you do? I mean, don't you cave to your shareholders and say, fine, take the dividend, even though it may not be the right choice for shareholders? And maybe they just don't know.
That's what they did. I mean, that's just effectively what they do, because, you know, if you have enough people say, I mean, the dogma of dividends is so pervasive, and you know, if a company is hit so many times saying, what are you going to do with the excess cash? Why don't you pay a dividend? They end up doing it. I mean, really, the choice for Apple was, can we find an investment that can generate expected returns greater than our return on equity? Well, Apple has return on equity of about 40%, so it's very tough for them to find investments. And so at that point, they have to determine, should I buy back shares or should I issue a dividend? And in my opinion, they should be buying back tons of shares. That's the best thing they could do, because it doesn't hurt investors, because investors don't have to pay the dividend.
Cameron, I know that you're not a political strategist. You're a stock guy. You're an analyst. That's why I like you. But I do want to ask you, what do you think the chances are that the Bush tax cuts are going to expire, and that some of the highest earners in this country are going to have a 164% jump in their effective tax rate when it comes to dividends?
Can you tell me who the president's going to be?
No. But I thought you might have an inkling of it.
That'll help me determine if the Bush tax cuts are going to be extended.
The reason I ask is because I know your clients are asking you this. I know that you've got people that are knocking on your door saying, what do you think is going to happen? Because you've got to make your trades and your investments this year based on what happens in the tax year next year, and it's tough to do sometimes.
Yeah, no, it is. It's very difficult, and it's a bad timing for Apple to issue this kind of dividend, because, you know, there's a penalty that's being imposed on investors today, and it's 15%, but a 35% bogey come January 1st. I mean, that's a huge penalty for that dividend being paid. That dollar could have stayed on Apple's balance sheet, or it could have been given back in the form of buybacks, but to cut that dollar into 65 cents for every dollar that's being issued in dividends, that's a huge penalty.
Well, I don't know. The way that Washington seems to work, they always end up pushing it through to the end, and then into the next 3 months of the next year. Cameron Hight, risk manager with Alpha Theory. That I do know. Thank you, Cameron. Appreciate it.
Thanks, Cheryl. Appreciate the time.